Welcome back to the channel. Glad to see that you came back. As promised, weekly videos. We're talking about finance, investments, personal finance, debt, credit cards, things along those lines. Before we start, I need you to smash the like button, hit the subscribe button, and put on those post notifications. Now, today we're going to be talking about leverage buyouts. I wanted to get into a little bit more of a, I would say, intermediate to complex level as far as corporate finance is concerned. And this kind of goes out to the people that have a really good understanding of what's going on. And for the beginners, stick with me. I'm not going to make it too complicated for you, and I'm just going to give you a basic overview. Okay, the leverage buyout basically is just a private equity company that's going in and sees a target, an acquisition target. This acquisition target usually is a company that is not highly leveraged, meaning they're not carrying a lot of debt, and they have a lot of really defined, predictable cash flow. And they also have good growth potential. So this particular private equity company will go in and purchase company A using more leverage than debt. Now, back in the days in the 80s, you could pull this transaction off with a more 95% debt and 5% equity from the private equity company. Now, nowadays, these things have definitely changed. You can't pull that trick anymore. Right now, financial institutions are looking for a mix of more 70% debt, 30% equity. You might get away with an 80-20 split, but like I said, those days are over with. Now, let's go back to the big days when Wall Street and this quote-unquote age of hostile takeovers was really big. One of the major players, actually there were two major players back in those days, but the guy that really came on the scene was a gentleman by the name of Henry Kravitz. Henry Kravitz founded KKR back in the late 70s, and he really blew up in kind of like the mid 80s. He was a private equity titan. He was also featured in a book called Barbarians at the Gate, which is, if it's something that you're interested in, you definitely want to check it out. And it's, like I said, Barbarians at the Gate, the fall of RJR Nabisco. And like I said, he was a kingpin back in those days in the 80s. His claim to fame was raising capital via junk bonds. Reason being because financing using the junk bonds was very quick, and the deals would get closed at a much faster rate. So that was kind of like his claim to fame back in those days. Another gentleman that came along in that era along the ranks was an African American by the name of, I'm sure you've heard of him before, Reginald Lewis. He was a Baltimore native. He graduated from Harvard Law School, and he also had a book. He's got a book out, Why Should the White Guys Have All the Fun? Now, Mr. Lewis was responsible for one of the largest transactions made by an African American. It was $985 million. This was back in mid 80s, late 80s. This was definitely a big deal, huge deal, because it was a Beatrice acquisition. Now, 985 million in current days money is, we're talking about close to $2.5 billion. This is a huge deal, definitely a huge deal. And the irony of the deal was he only put up a small portion of his own money. He only put up around 15 million to get this deal done. And it was fell underneath his pretty much his company, which was on TLC Beatrice International Holdings. That was his company back in those days. Now, these guys were pioneers that kind of like led the charge of the leverage buyout back in those days. Now I'm going to go, that was a little bit of history of the leverage buyout. Now I'm going to go into a little bit of what the leverage buyout is. Companies, these PE companies, private equity companies, they're looking for an acquisition target, and they're looking for certain characteristics. And those characteristics I mentioned earlier, they're looking for predictable cash flow, they're looking for growth potential, and they're looking for a company that has low capital expenditures. And what they're looking to do, like I said earlier, is they're looking to acquire that company using debt and then lever up looking to exit within, I would say, 5 to 10 years. Upon exit, they're looking to have a return on their investment between 20 to 25%. And that is not a bad day in the office if you can get 20-25% of your money between 5 to 7 years, or stretch it out even longer. Now the exits more so, we're looking at an IPO or we're looking at an acquisition. That's how these private equity companies are looking to exit the transaction. Now, some of the participants in the leveraged buyouts are, of course, the private equity companies, which are also called the financial sponsors, the investment banks, the bond issuers, the bond investors, and institutional lenders, and of course, target management. Now, Henry Kravitz, he loved, or he had a way of speaking with the board of directors. He had a way of making them feel very comfortable, and also he had a way of letting the team understand what his vision was. And he was very upfront and a very diligent person to be able to make these board of directors and the individuals of the companies say, okay, this guy is for the company. He's a company man. And he was able to do that numerous times and make the bankers feel comfortable in the deal and follow through. That was the most important thing. He said what he was going to do, and he was able to follow through numerous times. And that was definitely, those are the big days. Those are the big days. Now, moving right along, we have, with the structure of the deal, I talked about a little bit earlier, the leverage. Within that leverage comes a benefit. Within the debt comes a benefit. And that debt, the benefit to the debt is called interest expense, which is also used as a write-off. So what you're looking at from the enterprise value of the company when you start, that enterprise value will increase, or you're looking for it to increase at the end of the year. For those of you who don't know, enterprise value basically is the market value, market capitalization of the company, and you're subtracting the debt, and then you're going to add in cash and cash equivalents, which gives you a more accurate depiction of the true worth of the company, as opposed to just the market capitalization. Market capitalization of a company is just basically stock price times shares outstanding, but does not include any debt, any cash, or any cash equivalents. So when you're looking to analyze a company, you want to definitely look at enterprise value. That is a more, like I said, accurate depiction of the company from a net worth standpoint. Moving straight along, that kind of is an overview of the LBO model and some key components of the LBO model. And the capital structure is, like I said, it's very important to structure the deal right. And it can get very complex because one of the ways that private equity companies cut costs is by reducing headcount, or by selling off assets, or selling off parts of the company. This means jobs are getting cut. This means divisions are closing. This means there's going to be cutbacks on the board of directors as far as any extra expenses that are going on. And Henry Kravitz was a mean guy. As far as business is concerned, if there was something to cut, he would cut it. And that's what he did. And leveraged buyouts are deals that sometimes aren't that friendly. They're definitely not that friendly. So I just want to kind of like give you a kind of real top level view of the leveraged buyout, how it works, a couple of components of the leveraged buyouts, the exit, things along those lines. And hope you like the video. And moving forward, I'm going to keep going on with more and more Wall Street terms and terminology and different scenarios, and try to go into some case studies to get you more of a better understanding of what's going on. Smash that like button. That's all I have for today. Hope you're having a great day trading, and see you again next week. Thanks.